Welcome back to the Faith and Finances podcast. This is episode 190. We're entering into the tax season, which is really any time after January 1. We're gathering all of our evidence and receipts and giving statements and all the proof that we can to bring to the tax person to pay less taxes. And normally we have up until April to do that. Not a fun time, especially on the heels of celebrating Christmas and New Year's. Now it's tax time. Well, hopefully I can put a little smile on your face, give you some hope and encouragement that while, yes, we need to pay Caesar, we can also honor the Lord and pay Caesar less. Let me start off with a quote by Judge Brandeis of long ago. And regarding income taxes, he says this: "It is every taxpayer's right to either reduce or avoid taxes that would otherwise be due by means which the law allows." That means if it's legal and God-honoring, you can reduce your taxes. So the approach we want to take here is, one, sometimes we're trained to think that a refund at the end of the year is a great thing, like a bonus from work or better. But it's not always the best thing. It could be good, but not always best. For instance, if you're making $40,000, $50,000 a year, and we've got the current tax breaks and the quite favorable and generous standard deduction in a household, married household of $26,000, then your first $26,000 of income is not taxed. So everything above that is being taxed. So if, for example, again, you're making above that threshold, that standard deduction, $40,000, $50,000, $60,000, and you're getting a refund every year, I submit that we're not being efficient. That what that actually is you're overpaying the IRS and just waiting 12, 13, 14, 16 months to get your own money back. Let me ask you a question. If, for instance, your refund is $2,500, and it's been pretty consistent over the last few years, could you think of something more beneficial to your family, helpful, ways that you could utilize $200 a month throughout the year and improve your finances and improve your financial health versus waiting till April of next year? So you see, that's not the goal, is to wait to get your own money back. Talk with your tax person about increasing your dependence. And that's not the number of human beings that are dependent upon you. It's all math, how much they take out of your paycheck. So if in reality you are overpaying taxes, you want to lower how much is being taken out for taxes, so that you have that refund monthly throughout the year instead of waiting. And that's something that you can do on your W-4 form. Check with your employer. The law, the IRS allows you to do that quarterly. You can just make adjustments. It's math. You don't want to end up owing, but you also don't want to end up consistently year after year getting this huge amount that you could rather have during the year. Now, speaking of standard deductions, I want to be a help to you and bring you up to speed. We are in 2024. This is the last year of the Trump administration era tax breaks. Your marginal tax brackets have been lowered on average by 3% per tax bracket. You've been paying less in taxes. And your standard deduction prior to President Trump's administration and the Jobs and Tax Cuts Act, the standard deduction for a married couple in the household was $12,600. This year it's $29,200. This is a good year. It's also a good year to be proactive rather than reactive. I submit that most of the time we're reactive. We go along and we do what we're doing throughout the year, and then the year is done, December 31st. So now we have to get the evidence of what happened and hope for the best. We can be proactive and plan and take certain steps within our budget to reduce the taxes that we will pay next year. And it doesn't mean maxing out your 401k or IRA. I have taught classes on that. That's just putting off taxes till later. I mean real tax planning. And with the time that we have, this is not exhaustive. But please know that your tax person, you probably chose a good tax person. They're going to strive to get you to help you pay less for what was already been done. There's nothing else to be done, again, unless you have the window of time and you put some more into an IRA and get a deduction there. But again, that's only putting off taxes till later. We want to be proactive so that we know we can take certain steps throughout the year to reduce the taxes that we will pay next year. So we want to look at underutilized tax strategies, and let me just throw out a couple. One is the HSA, the Health Savings Account. Many employers are offering that as an employee benefit. Do check into that. If you are self-employed in this gig economy, if you have your own home-based business, you're a graphic designer, you do things online, you're an Uber driver, you do deliveries and you're 1099. Oh, there's many things that you can do, including an HSA. With this health savings plan, you are able to place money into this account, reduce your taxes, and in 2024, for a family, you can put up to $8,300 and reduce your reportable income by $8,300. That's $8,300 that's not being taxed. So the intended purpose is to use it for health expenses. However, there's some excellent benefits that are often overlooked. And again, as Judge Brandeis says, if it's legal, you can do it. I utilize it. Many clients that I have advised utilize it as a future tax-free income. Let's say, for example, on average, you've got some kids and they're always getting sick and they give you the cold. So you've got doctor visits and it's that copay and you're out of pocket. Let's say on average, $300 a month. Well, there's really no tax break for that. You're out of pocket $300 a month. If you put that same $300 a month into your HSA, health savings account, you actually get a tax deduction. And then, so in other words, that's tax-free. And then the next trip to the doctor, you take out your HSA debit card and you pay for that medical expense, that doctor's appointment. With the money that's in the HSA, that comes out tax-free. So if you've got the out-of-pocket medical expenses anyways, why not get the tax break, the tax deduction? Now, you can max that out as a supplement to your retirement planning. And let me show you how this works. I and many others do this. You make your contributions into your HSA and you don't use it for your medical expenses. You just pay. And maybe your medical expenses are low. Well, you do this year after year and you invest that money and it grows in the market. Now you've got tens of thousands of dollars. You're allowed to keep the receipts for the medical expenses that you actually incur and pay for. We call it shoeboxing. Keep those receipts. Nowadays you want to scan it and keep a record. Maybe you've got beyond your copay for the doctor visit, $40, whatever that is. Maybe you're responsible for your portion of the dental work that was done, the x-rays, and you went ahead and you paid $170 or whatever that is. You paid for it. If you paid for it, keep that receipt. Keep the invoice or the breakdown, what it was for. Oh, it was your portion of the x-rays that were done. Keep them. Anytime in a future point, you can submit that receipt that you paid for medical expenses in the past and get reimbursed from your HSA tax-free. What does this open the door to do? Reduce your taxable income every year. And especially if your medical expenses are low, forget it. Just keep your receipts. And then later, whatever you have done for your future retirement planning, your 401ks, Roth, IRAs, and such, you now have tax-free income by every month, just going back in that shoebox, going back to your cloud file where you've scanned all of these previous receipts for all the years past. Oh, here's $170. Why do I keep going to $170? $300 for the MRI, whatever it is, braces, cavity work. I got sprung my elbow and I'm in a sling and I needed to pay for that, but I kept the receipts. You just start submitting those and you get checks from your HSA tax-free. Money goes in every year, you reduce your taxes that year. Money comes out for medical, present or past, it comes out tax-free. Check in with your employer. If you're self-employed, look into HSAs. There are HSA services. Look online. There's lively.me. There's health savings plans. Actually, that's the name of them. Look into them. And you can contribute monthly. So that's just one way. Secondly, if you are doing so many households now are picking up extra income by delivering food, by delivering people, by working from home, and this is all side income, or you may do it full time, but what you find is you're not a W-2 employee where you get taxes taken out of your paycheck. You receive a 1099. They don't pull taxes from that. A good practice is for you to immediately set aside what's called your gross income. You got paid, set aside a portion, get a savings account, call that taxes because you are going to pay taxes on that income. You're going to report it. But what I want to help you with is, in addition to the household standard deductions, which for married couples $26,000 and it's $14,000 now for a single filer, used to be $6,000, so this is the last year where you got a really good standard deduction. You can list your business expenses. If you're driving, what's your biggest expense? Well, it's not the gasoline that you're going to deduct. It's keep track of your miles. You're going to deduct how many miles you drove to the tune of 65.5 cents per mile. Think of it. That really adds up. Now, if you're really going at it, I got some friends that make a lot of money Uber driving and Lyft driving and such. If you did 1,000 miles and you kept a log, keep a log of, I went on this day, these were my trips, this was my starting and ending mileage. It's worth the trouble to do that. If you did 1,000 miles a month, that's $655 that you get to write off your income just in auto expenses. When you use that deduction, it covers gas, repairs, so you're not deducting your oil change or any service or your gas. It's all covered in this one deduction, 65.5 cents a mile. If you need training, subscriptions, other materials for this business, you can deduct it. The key is keep records, show your tax person. But many folks are out there doing side jobs, side work, and they're not even thinking about the related tax deductions that they can track. You can do it on an app, whether it's just the Notes app. This is the date, this is the starting mileage, this is the ending mileage for that day. That's it. Do the math at the end of the month, at the end of the year, all those thousands of miles, what a huge deduction. So the key is be proactive and look at what you can do with the money that's already in your budget. Look for those tax deductions that are legal and honor Caesar. It's okay to pay them less. Still honor the Lord. Of course, honoring the Lord is our first priority. There's also a charitable deduction that changes year to year in addition to the standard tax deduction. So check with your tax person on that. Unless your giving exceeds that $26,000, you're not going to add all of your charitable giving on top of your $26,000. They give you a small allowance. But look and know what your tax deductions are ahead of time so that you're not reactive. And I hope that gets you thinking proactively through the year. What can I do now? And it's not always maxing out your IRA or your 401k. For those of you who are self-employed, you could do a self-employed plan, a SEP, or a solo participant 401k, and actually put away up to $62,000 per year if you can, and reduce your income from that. But keep in mind, you're going to pay income taxes on that later. But with that same 401k, You can also do a 401k Roth, and do so tax-free. Ask these questions. Look into your options. Be proactive with your taxes. Honor the Lord. Honor Caesar. You can pay Caesar less. We'll see you next time.